Okay, let's take a look. Now this you can wake up now, okay? It's time to wake up. And we're going to take a look at the stock market. Let's take a 5-minute break, and we'll come back and we'll see if we can make some money tomorrow, okay? Guys, ready for the stretch run here? Sound check. Somebody, let me know you're there. Anybody out there? Okay. Hey, Scott. Good deal. Super. You know, I have this fear, this legitimate, well-earned fear that I'm going to be sitting here talking for 45 minutes and my microphone's off. I've done this in the room a lot, so it's a real possibility. Okay, we're going to talk about the stock market, which is absolutely fascinating right now. Let me pause this 1 second here. Okay, this is the Dow, and we closed, this is the monthly chart of the Dow. We closed at an all-time high today. That's quite historic. You know, we have the move off of this low has been quite a move. You know, we've had past ramps, you know, beginning back in 1980. I started trading right here. I've now raised my stop on my long position I took here to right here. I wish. But you can see the market is at a critical psychological inflection point. Now, the reality is that, you know, the Russell has been all-time highs for weeks. The S&P is knocking on the door. Let's see how far. It's about 3% from a closing all-time high. So I'd be a little bit surprised if we don't see that. So what do? What do we do here? You know, do you sell this market? Do you buy this market? Well, I think some of it depends on the time frame you trade. And if you are an investor, that's a question everybody has to answer. I'm not personally in anything long-term with this market where it is now. I may miss, you know, the move to, I don't know, 2,000 in the S&P. I'm comfortable with that. I missed the move from here to here too, but I was comfortable with that too. So I may miss another move. But from a trader's perspective, if we're looking out 2 or 3 days, or if we're looking out 2 or 3 weeks, or we're looking out 2 or 3 hours, how do you trade this market? I mean, it's vertical, it's straight up. So let me ask the question, how do we know, what's the first signal that this market could be turning around? Is it different this time? I mean, are all of our auction market rules, do we throw that out the window? Or is this market not following these auction market concepts now? Yeah, well, there are 2 great answers. When balance areas are broken to the downside, and James Barnes says it closed below the low of the last day or 2. Yeah, guys, it's that simple. You know, if you're an auction market trader, you have an incredible, powerful tool, which is the worldview of how this stuff works. And it hasn't changed. It's operating the same way. We're in a, you know, we're in a trend. We are in an initiative move up. You know, initiative moves happen in different markets all the time. It just happens to be the stock market now, and it happens to be in all time frames. You have long-term, intermediate term, short intermediate term, short term, and intraday, all going the same direction. Now, that's a little bit rare, okay? and that's important information. We're going to talk about that. But now, this market, the signal that this market is beginning to, something could be going on. Now, again, this is the cash to the downside. We use the exact same concepts now that we used last week, last month, last year, 3 years ago, 5 years ago, 9 years ago, 30 years ago. You see, this is an auction. These are the day auctions of the S&P. Now, when I do tonight's DBSA, the level that I'm going to point out, now it maybe I'll show you the futures in a minute, but if this market closes below today's low now, that's the earliest objective signal that suggests that there could be a potential top forming. And quite frankly, based on the other information that we know from an auction market perspective, it's very, very, very unlikely that whatever top is put in short term, whether it's here, here, or here, is the final high in this market. Let's go back and revisit that concept real quickly. This is a monthly chart. What do you notice here and here? And I can go back into other areas as well. But in the top in 1998, and the top in 2007, 1998, 2000, and this top, what do you have here that you don't have here? So far you have a spike high. Now, could this market in the next day or two turn around and screen lower? Yes. But when you're looking at this perspective, and remember, this is a concept that the principles apply in all degrees of time all the time. So we're looking at a really long-term time frame here, guys. This has, multi-year, if not decade types of implications to it. So if I'm looking at this is sort of the area, if we were to take this low out here, which is now the January low is all, then, okay, then maybe this could be a top. But it's still, even if this is taken out, this is likely to be revisited. Look how long it took to form these tops. Now this is monthly, so that's probably of academic, I guess, interest. But let's go weekly and see what we find. Okay, let's look at the tops just since the 2009 low that formed. This was a little top. This was a top. This was a top. This was a top. This was a top. All of these have in common? Now, again, this is weekly. They all took out. Well, this is an exception, but the thing this has in common with all of these is it took out that second week's low. But most of these tops, with this one exception, and this was only a short-term top, and it bottomed right where it needed to bottom, right into this volume node. It took time to form these tops. So it's really unlikely that if we form some sort of short-term top up here, that it's the final top. Now let's go to daily. All right, now let's go back and revisit these tops. Okay, now even the top that on a weekly chart looked like there was no balance that formed, you can see this formed a really nice pristine balance area back here in 2010. And then in April, we formed this nice top. This was a bit of a funky kind of sort of top in here. This was a long-term top, but it had tops within the tops. I think this is, if I had to guess, this may be what we ultimately end up seeing, which quite frankly would be wonderful because it's a wonderful trading type of environment. Here are the tops from a year ago, and this top was revisited. So you had a balance area here, and then you had, and we'll talk about this, these concepts, but here's a balance area, here's your selling tail. You know, all of these auction artifacts, these selling tails and these balance areas, you know, they happen on, you know, we're looking intraday, especially those of us that are in the live room every day. You know, we're looking on 30-minute charts and thinking that's long term, and you know, we feel good if we let it set up on a 30-minute chart. Well, the reality is they set up on a daily chart too. The same artifacts that you see on a 5-minute chart, the same auction process that creates those artifacts works, is in effect in these longer-term time frames. So, and now that brings me to where we are now, and this is a daily chart. Now, if you get on the internet, you're going to read, you know, all the predictions come out of the woodwork. I mean, you've got people now predicting that the S&P is going to double in 4 years, and you have people predicting the end of time by Friday. You know, whenever the market is trending, especially when it's at new highs or you know, important pivot lows of a yearly nature, you have both the predicting parties come out of the woodwork and start predicting either, you know, you know, we're on the cusp of an acceleration to whatever, or you know, it's the end of time, and you know, you better get short. Not sure how that's going to work out for you if it's the end of time, but that's the theory. So we can sit back, and if you forget the fact that the market has had this incredible bungee jump, and it has been incredible, let's just look at what's going on right now. And James, you know, you calmly typed in second day back. Here's your second day back. Now that second day back would also coincide with some rotation in a high volume node in here. Now let's note that. Let's see, this is 1498. Well, let's see where 1498 is. Oh, this is daily, no wonder. All right, here it is right here. Today's low. And that would put us below this high volume node. So this is an objective, calm, deliberate analysis of where we are and what's going on, and it's tradable information. Now we're going to make it even more tradable in just a minute. So you don't have to worry about what Tom DeMark is going to say on CNBC tonight, or what Jim Cramer said, or what Ben Bernanke and Tim Geithner may not do. The auction, regardless of who the parties are or the exogenous drivers of it, is still in effect and chugging along and performing just like it did pre-2007, you know, pre-2000. I've shown, you guys have seen me show charts of the Dow back in the 30s, and you see the same stuff. So these artifacts give us a comfort level that the auction process is alive and well. Now, one of the things that I did this weekend was to take a look at the extraordinary vertical nature of the market. And what I found was, well, that's not what I found. Let me find what I found. Here it is. I took a look at, and this is the S&P, obviously, and I'm using the S&P because if the S&P is going to make a significant move, so is the Dow, so is the Russell, and so is the NASDAQ. And I took a look at the rallies following declines of 9% or greater since March 2009 and how far they carried. And the initial rally off the low in 2009 carried, I'm having trouble reading that, 43%. And then this was just about a 9% decline. And then the next rally carried 32%. This one was 16, this one was about 32, this one was about 20, this one was about 22, this one was 16, and the rally off the December low so far is just a little bit over 12%. Now, I'm in no way, shape, or form am I suggesting that we can somehow get valuable information that we're going to trade on because you know the greatest rally off of decline was 43% and the least was 16, and this is only 12. I'm showing you this to show you the magnitude of some of these rallies. And one takeaway, one anecdotal takeaway is that, you know, we've had a lot of rallies, several rallies in this market that, well, actually all of them so far have exceeded the rally we've had off at this low. And some of them in roughly the same time frame. You have everybody going nuts right now because we're close to all-time highs. So, you know, be aware of that. Now, here are the declines. And you can see this is, you know, we've really had two protracted declines. We had one in 2010, and then most of 2011 actually was a rotational market with a downside bias that tested this area in here. You can see where we spiked in here. So once again, these auction concepts work in all degrees of time all the time. If this were a profile chart, this would be a high volume node, and this would be a spike down into it, and then, you know, this was a false breakout trade. That's another auction market concept, and that's a trade setup we'll talk about. So you see the setups, you see the development, you see all of the things that we use to analyze and trade an auction market all degrees of time all the time. Now, one thing that I did find that I think was really enlightening. I went through, and this is called not having a life, okay? I went through and I took all of those rallies and I put them on a 120-minute chart. And then what I wanted to examine was the personality. You guys have heard me talk about the personalities of rallies before, and I've always used that when I'm talking about breadth and how, you know, breadth will develop a personality against a given trend, and it tends to stay in that personality. It tends to not exceed a certain level to the downside on retracements in an uptrend until the trend is changed. And when it does exceed it, then that's one of the signals that the auction has changed, that the supply-demand equation has shifted somehow. And another thing that I've done I did, I went back and I looked at the retracements within these furious uptrends that we had to see if there was some sort of a pattern, and there is a pattern. Most of the time, and this is we're pushing the time here, so I'm not going to go through all of these charts, each time frame. But the takeaway from this, and I'm going to bring it forward to make it relevant immediately. But each of these trends until they ended, tended to have 2.5% retracements as a maximum, and most of them had something between 1 and 1.5% retracements from the high point to the low point of the retracement. Now, you can't trade this in a vacuum, obviously, and I don't suggest that you do that. Everything that I trade in this has to be framed in the context of an auction market. And the other thing that I did that we're not going to have time to discuss tonight is I went back and I looked, okay, this retrace. Now, where was this retracement in terms of this auction? What was the information? Should it have stopped here? Was it logical from an auction perspective? And the answer was yes. Now, the point of this is, there's a couple points. Don't expect, you've heard Troy and I talk about this before, when you're taking counter trend trades, I'm going to short this market. I mean, I'm willing to play the short side of this market. I tried it today and got stopped out. But I'm willing to play the short side of this market. But I have to be aware I'm fighting the trend in every degree going right now. So if I get a short trade on and I get a retracement to the previous day's low, and that previous day's low is, somewhere between 1% and 1.5% from the high, that's probably a good place to start tightening my stop or taking partial profits on the position. Now, what happens is if all of a sudden we get a 2.5 or 3% retracement, well, that's a heads up that maybe there's going to be more time spent than these sharp retracements that you see. Now, this happens to be 2010. Let me find the present, since we're in the present, right? Seems to make sense. Now, this is the S&P. Before I show this, I want to show this. I want to show the profile view. Because it's easy for me, and I think it's easy for a lot of you, that a lot of the clients that have been with us for a long time, to look at this chart and to see, quote unquote, the market profile. If you're not familiar with the profile, you're looking at this chart and you just see a chart. But there's really much more information here. And this is what it is. When I look at this bar chart, this is what I'm seeing, or it's what I'm trying to see. Okay, now, this was December 31st. And on December 31st, we had this rip-roaring trend day. That's a market profile term. To the upside. The market opened near its one extreme and closed near its other extreme. That's a trend day. They're rare, relatively rare. Days like this are relatively rare. And then we began, what did we begin? Well, we began a migration of value higher. Value, simply put, and we're going to go into this in detail. I think it's next week. I think that's on the agenda next week. But for those of you that are new, the little gray areas, these are areas, this is the greatest value in this structure. This structure is an auction. So, you're going to have rotation. The auction sets an extreme. All auctions have an extreme. They have an upper extreme, a lower extreme, and an area of greatest relative value. And you read the market and determine the trend of the market by the migration of that value. And until this migration is broken, the trend is up. And you can go through here and you can see how elegant, as usual, this auction process is in migrating higher in an orderly fashion. Now, if you get on the internet, you think that there's this, there has not been a downtick since December 31st. The reality is, it's been a pretty orderly advance. It's been, the retracements have been shallow, but we've had, you've got an upper extreme, a lower extreme. You have development. The auction matures. You break out to the upside, and it starts over. So you've got this orderly procession of value higher in this market. And as Troy posted, which also would coincide with the signal James gave, the initial signal that something could be awry now is if the S&P closes below today's low. And it's for two reasons. It will be taking out the high volume node of the most recent auction, and it will be closing below the low of the previous day. Now, if this is taken out, what's the next level we're going to look at? It's going to be this one. And the guys in this that are in here that have been in this room and that trade this will tell you it's not magic, but it seems like magic sometimes how these markets will honor these volume nodes. Now, these volume nodes, I want you to understand, I don't want you to view things like this as support or resistance. They're inflection points. Now, there are certain rules, and we're going to go over this. Not rules, but guidelines. The trend of this market's up, so you're more inclined to be leaning towards this acting as support than the market blowing through it, because the trend is undoubtedly up. Okay, so let's go back now to the immediate trend and talk about the personality of this market since January began and since we gapped up here. Now, the other interesting thing that I find rather amusing, always find this amusing, we have this big gap here. Now, there's this magical school of thought that the gap's going to fill in. Well, it may, but it just may not be in the lifetime of your account. So the gap thing, from an auction market perspective, is what Stellmeyer referred to as minus development. It's a one-sided market. And yeah, this gap is likely to be filled in, but it's not because of some magic or some undeniable pull. It's just it's going to be part of the auction process. And this is unique because it truly is a gap because of the holiday. Most gaps that these guys refer to aren't gaps because they're not acknowledging what happens in Globex. All right, let's look at the retracements that have occurred since January in this market. Okay, there's 1.18%, so less than 1.2%, right at 1%. 1.02%. Now the retracements are getting shallower. Not even 1%. Less than this, not even 1%. Not 1%. Not 1%. Not 1%. So, and I spent way too many hours this weekend going through every trend similar to the one that we're in this market since March 2009. And the trend that we're in now is up there in terms of not so much distance yet, but with the lack of retracement, both in terms of depth and time. We've had very little of the balance areas that you typically get. And that's, that was my, let's call it an excuse, since it turned out not to be a very good reason. That was my excuse for selling this thing today. I was thinking, well, we really haven't had a 1% retracement in a long time, and we're overdue for 3 or 4 days of chop. So I'm going to be smart and sell this, and I'll buy it back down here while I got run over. Okay. But that was the rationale. So the message here is if you're selling this market, if you get a 1%, or something, and it's into an auction market level, you better take your profit. And also, if you get a 1% decline, if you want to be smart and just trade with the trend, then you're looking for 1 to 1.25% decline, and see if it coincides with, when it retraces, one of these levels. Now, this will be an important level. This actually should hold. This is an attempted initiative breakout of this balance area. So this is, overnight, we'll see what happens, how the market develops, but this will be an important area. This is an important area. Today's lows, today's lows tested this low and this low. This is a buying tail. This isn't a buying tail, but the market spent very little time down here. Same effect. So hopefully I've shown you a couple of things that will be immediately useful to you in your trading. Number one, you don't have to lose sleep over when the market is going to turn. You'll get the signal and recognize it before almost anybody else. In the meantime, the trend of this market is up in all degrees of time, all the time, and the retracements are, so far, they're really, really shallow. So I don't see any sign of a lack of desire to buy this market. If anything, it might be increasing. So if you're shorting this market, like I tried today, you're really guessing at a top, like I tried today. and the smarter thing would have been to buy this thing when it was down here. Now, I keep expecting this market to become more two-sided than it has, but it may go up 4 or 5 more % before we see a 2% retracement. So be aware of what's going on. The auction process is in effect in this market, guys, but it's also the phase of development of this market is initiative. The path of least resistance is up. And, the better part of valor is being patient and letting some of these levels come out to the downside before you get aggressive shorting. If you're going to short this market, you're doing it with small size and you're quick to take your profits. Don't try and be a hero and be the person that called the all-time top, because it's very likely this isn't it, even if we retrace back down to, the beginning of the 2013 trade. So guys, questions, comments, observations? I don't know. Matter of fact, I doubt I'll have the recording rendered in time to have it in your box tonight. But I will. It'll be there tomorrow. Please try and review this. Those of you that are, especially those of you that are doing this for the first time, try and go through this at least once before next week. And then if you have any questions about anything that we've talked about, most of the stuff this week was of a conceptual nature and background nature. We'll get more into meat of things next week. But if you have questions, let me know. Thank you, Bill. I very much appreciate all of you and your time. So, Michael, you say a year ago we had much wider daily ranges. What does the auction market methodology help us in this? I don't understand. I mean, it's Michael, if I were to show you the S&P, give me a date. Give me a contract. December of 2011 or September of 2011. September 2011. Okay. Let's look and see. Okay, here's the September 2011 contract. All right, I'm going to go back. So this started in June, right? Okay, probably started somewhere in here. Okay, now let's do this too. All right, here's the bar chart, and then we'll look at the profile chart. So this is the September contract. All right, the September contract, let's see, September 1st. September contract probably became front month somewhere about right here. Right, probably right about here. Interesting. Well, this was I could look at the bar chart and tell you this was much more two-sided, but that was my point. Trends have different personalities. The personality of the trend we're in, it is what it is, and it's going to stay what it is, and knowing what it is gives you valuable information. It will be quite, these trends that establish themselves in these rallies, that they develop a personality and they stay very consistent. Now, all right, now this is that September contract. So we migrate higher. And then you did get, I mean, you did have some rotation in here. We have not seen this at all in this rally. Now, what is this? This entire thing is an auction. So you've got to take all of this. This is all one auction. Sort of a funky auction, but an auction nevertheless. And then on the 27th, you began migrating higher. Here's your migration of value higher. And it did become rather, the trend rather pronounced off of this volume node. And this is that September contract. Okay, and here you had some rotation. You know, you had another balance area that formed. And then the market traded higher in here. And then look, you know, here was your initial signal something was awry. You had this big move in Globex that took out the previous day's volume node, and look where it stopped. It stopped right in the high volume node from this structure. And then the next day traded into this overnight conviction, and you started down. So, you know, Michael, that's one of the cool things about this. You use the same concepts regardless of the range, and that speaks to the robustness of this. Regardless of the volatility and regardless of the range, the auction is in effect. You know, one of the seminars that I've given, one of the courses has this example of VIX in 2008 when the average true range was something like, I don't know, 60 handles. You know, the VIX was just, you know, I don't know, it was astronomical. It was an all-time high. And then I showed an example of the VIX and a profile from 2007 when the VIX was like, you know, 9. And if you looked at those two, they both looked exactly like this structure right here. So the auction is dynamic. It's in effect. You have unfair highs, you have unfair lows, you have a range of relative fair value regardless of the volatility or the lack of volatility. That's what makes this tradable regardless of what's going on. You just have to be willing to accept what's going on and not say, wow, you know, sure isn't much range here, I can't trade this. Well, just trade what's there. And if what's there is not going to change, if you can't trade it, then don't try, because it's not going to be something that it's not until it changes. Robert, I'll talk to you about that tomorrow, okay? I think Ninja has profile charts, yeah. You can get profile charts a number of different places. I'll call me and we'll talk about it. Guys, Michael, that was a good question. You know, basically, the auction is there, regardless of the volatility of the range. Thank you, Kim. So, guys, anything else? Robert, this is the tip of the iceberg, buddy. Sean, I've always been skeptical of paper trading. Do you think there's an inherent difference between virtual money and real money? Yes, there is a real difference. Most definitely. But you're smart. And I used to not believe in paper trading, but I do. I do now. I really do. I've seen too many people. It's just, you're going to, people that begin to trade with real money always lose their money. Always. Paper trading gives you the best chance of not losing your initial trading capital and of actually becoming profitable out of the box. It gives you the best chance out there. Now, it's not the same for a lot of reasons, but it will at least get you in the practice of identifying and executing trades in areas, which is what you need to be focusing on anyway. You need to be focusing on not so much how much can I make paper trading, but am I consistent in my process of my entries and my exits? Am I identifying good trade location? And if you do that paper trading, then there's no reason you can't do it with real money. But it's not a game to see how much money you can make paper trading and then see if that translates into the same amount of money real trading. Robert, did you see John Ocknick? He posted a profile chart plug-in. Here, you see it? Thanks, John.